Good morning, everyone, and thank you for joining us for the most technical session on accounting, which is debits and credits with journal entries. We will try and make it user-friendly, hopefully. If you have any questions, we'll be very happy to answer them. And let's start with our PowerPoint presentation here. So in financial reporting, in our bookkeeping, the whole purpose is to produce the reports, right? And the reports, the main reports are our profit and loss or income statement that shows all the income and expenses and the net surplus or deficit. And then our balance sheet. And balance sheet is the assets and liabilities, or what we own and the debt we have, and then our net worth, or our organization's net worth, right? So now when we think about it in our mind, in the rest of our life, we normally think in terms of profit and loss. That's kind of easier to comprehend because we do it at our house, like for our home budget, like in our head, okay, what's the money coming in? What are the expenses I have this month? And what's going to be left in the end? Hopefully something is left, not all spent. Balance sheet, however, gets overlooked because we don't think in those terms, but it really is a statement of net worth, as hopefully we all know by now after our previous sessions. We have our assets in there, such as bank account, maybe vehicles, maybe a house, a building, and then we have our debt that is deducted from the assets to arrive to the net worth. So assets minus debt or liabilities is our net worth, okay? So the way bookkeeping systems work, financial reporting systems, is every transaction that's entered is supposed to affect both financial statements. So it affects our profit and loss, but also at the same time, it affects our balance sheet. This is why it's referred to as double entry. In the old days, it was referred to as double entry, but this is the purpose. We're hitting both statements at the same time. So the system works. So at any point of time, we can print out a profit and loss and a balance sheet that are updated and relevant for as long as we have all our transactions entered. Okay, so let's just quickly take a look at a sample profit and loss and balance sheet. Just wait for it to load. So this is just a simple financial statements for a band member. Okay, so for the profit and loss or income statement, there is some salary and child tax money coming in, and then there are some basic expenses, groceries, daycare, hydrophone, car payments, and so on, right? And then we have total income, total expenses, and then net income, which is the difference between income and expenses. Okay, and then the balance sheet for the same band member looks like there are some assets here, what the band member owns. So there is a bank account, there is a saving account, some pension savings, a car, an NRV. Total assets are $62,000. And then liabilities or debt are car loan, some credit card payable, and some payroll advances. And so then the net worth for this band member is the difference between assets and liabilities. In this case, it's $49,000, right? And so going back to our journal entries, anytime we have a transaction, right? An accounting transaction is just a reflection of what happened in our operations in real life, right? So anytime money comes in, yes, it's income. But at the same time, that income gets put somewhere. It increases one of our assets. So we received a salary payment. Then on one hand, we get salary income here, but on the other hand, our bank account has increased. If it's a direct deposit going into our bank account, right? So there are always two things affected, right? Accounting likes to work in pairs. It's all about teamwork. Okay, so Or if, for instance, we maybe bought some groceries, went to Costco and, spent $200, because I've never been to Costco and spent less, then what's the other side of that? Well, if I use my credit card, then on the debt side of my balance sheet, now my debt, the amount owing to the credit card, has increased, right? So the whole key to understanding and making journal entries is thinking through what happened in an actual transaction, what happened in real life, so to say, right? And then if we understand what's affected, then a journal entry becomes easy, as long as we can see the two sides, okay? So for example, if we made the cash payment to the daycare here, the $300, then our bank account would be reduced by $300, right? Because money, what happened is we had an expense, daycare expense, we paid with cash, so expense increases and our cash decreases, right? So it's just a common sense kind of thinking. Okay, let's go back to our presentation. Okay. So transactions are posted to different accounts or categories in our records. And as we saw in our example, we have the income statement side with income and expenses. And then at the same time, the other side of the transaction always affects our balance sheet, right? So assets and liabilities. So the way our accounting system works is, even if we're using one of those really user-friendly systems, and instead of making journal entries or knowing debits and credits, we can say, okay, record an expense, or record a vendor bill, or record a customer receipt or a sales invoice, right? In the background, what the system is doing, it's actually posting debit and credit journal entries. It's just that new generation software has been really simplified to allow people that may not have a lot of accounting training to work with them. But we got to remember, everything we enter in our accounting system has a debit and a credit. That's just the way the system works, to make sure both our financial statements, the income statement and the balance sheet, are updated with every transaction. Okay. So now, when we talk about accounts or categories, like we said here, the main categories are income, expenses, assets, and liabilities. Every category has a natural debit or credit position. So here's where, let's say if I'm new to accounting and say we paid the daycare in my example, right? Say $300 daycare payment. So I know my expenses increased and my cash decreased, right? Cash in the bank decreased. Then how do I know what's a debit or a credit? Well, here we don't have to think, because the accounting theory already tells us what's the natural position for different accounts is, and we'll get to it in the next slide. So again, every transaction has a credit and a debit. Normally, a debit is positive and credit is negative. You'll also see in some software, or some old school accountant would record debit first, and it's kind of, if there is two columns for amount, the first column to your left would be debit, and then the next entry in the transaction would be credit, which would be a little further from the debit, okay? But they can also be viewed, a debit as a positive and a credit as a negative. And it's just the way the system works. I don't know if there is a certain reason when they choose what's positive, what's negative, but it's just something we remember. And then we work with what the accounting theory says, what is the natural debit or natural credit for different accounts, okay? Now, every journal entry has a debit and a credit, remember, and it has to balance. So my debit should equal my credit. So sometimes what happens is, in a journal entry, I may have more than one line for a debit or more than one line for a credit. For instance, let's go back to my daycare payment example. Maybe the $300, I paid 200 of it in cash, and then 100 of it I put on a credit card, right? So in my transaction, on one side, there would be daycare expenses, but then on the other side, there would be $200 in my, like, going out of my bank account, and then another $100 put on my credit card, increasing my credit card debt. Okay, so one side of the transaction has now two lines, two entries, and that's okay. We can have as many lines in every transaction as makes sense once we think through the transaction. But in the end, my total debits and total credits should agree. They should equal each other. In your accounting software, if they don't agree, if they're not equal, the software won't post an entry. It would scream at you, right? Okay, so transactions are referred to as journal entries. We talked about it. And every transaction we record in a system, it's a journal entry for the system. Okay, so in the background, the system is doing the debits and credits things, whether we see it or don't. Okay, so let's see here. Let's go straight to this natural positions for debits and credits, because we just talked about it. So remember how we said we have to think through every transaction and it has two sides. So how do we know what is the natural position for every side? Well, we just use the chart here because it's already in the accounting theory. Okay, so my assets and expenses, they're naturally in a debit. So if I want to increase an asset or record an expense, I will debit my asset or debit my expense. Now, liabilities, my income, and then retained earnings or net worth, they're all in a credit, on the credit side. So their natural position is credit. If I want to increase my debt, say my credit card, I have to credit the credit card, credit the credit card, lots of credit in there. If I want to record income, I want to increase an income account, I have to credit that income account. Okay, now you'll see when we say both financial statements are affected by every transaction. Well, you'll see here that, say, if I'm posting a daycare expense, then it's affected through the debit side. So debit daycare expense $300. And then on the other side, the credit side, I'm going to say increase a credit card, right? So increase my liabilities. So credit card payable, $300, right? So you see in the same entry, one line is affecting my income statement, which is expense. And then the other line is affecting my debt, right? And this is just reflecting on what exactly happened, right? What happened? Well, I paid daycare with a credit card. So then I have a daycare expense, and then my credit card debt increased. So I'm reflecting both of them in that one entry, okay? On the other hand, if money is coming in, if, say, I received funding from the government in a First Nation, say, right? So we want to record income, funding coming in, right? So income's natural position is credit. So we would credit income, say my funding is $20,000. And then what happened on the other side? Well, maybe money came in straight into my bank account. So now I need to increase my bank account by $20,000. So credit income and then debit bank account, which is an asset. And we can see in here that, again, both financial statements, my profit and loss and my balance sheet, are affected in the same transaction, right? And that's the goal of double entry accounting. Okay, so I know this is very technical and it could be confusing. So what I'd like you to remember is this comes with practice. So the more journal entries you make, the easier it becomes. But even when you've practiced accounting for many years, like myself, I still make mistakes. I still sometimes make a journal entry, and then my debit and credit don't go the right direction, okay? So in order for us to kind of catch that, to make sure our entry is going the right way, what's important is after every entry you make, check the results. So for instance, if I wanted to record income, if I wanted to record $20,000 funds coming in, and for some reason, I'm making a journal entry for it. So my journal entry would be to increase income and increase my bank account. That's what happened, right? So I'm increasing income, natural position is credit income, $20,000, and increasing my bank account, natural position is debit because it's an asset, right? Then debit bank account, $20,000. So now my next step to make sure my entry, my debits and credits were right, would be to actually close down posted entry and then go and check where my bank account and my income accounts are at. So actually go check those categories. So I look at my trial balance or general ledger for the bank account, right? And I want to make sure that it went up by $20,000 after I posted that journal entry, right? And same thing with income. I may want to go and check that that particular account, that category I was using, went up by $20,000. Now, if I check and it happens that instead of going up, it went down, and I know that my journal entry went the wrong way. And all I have to do is go back to the journal entry and correct it to switch my debits and credits. Okay. Okay. Like I said earlier, some accounting systems are designed in a simplified way, right? And they would, instead of posting journal entries, they show you tasks such as issuing a customer receipt or recording a bill payment. Some other accounting systems, in particular the older ones, the more kind of the more intense systems that are meant for bigger companies, Sage 300 would be one example. They still use the debits and credits. You still have everything entered through journal entries, so pretty much everything. And in that case, if you work in that software, then you know, you have no choice but to learn all your debits and credits and kind of work that way. So in a software where everything is user-friendly and simplified, and everything looks like enter a vendor bill, enter an expense, enter a customer payment, and so on, sometimes we still do need to make journal entries. And in particular, if we're correcting something that happened in the past, and there's just no easy way to do it through the software functionality, through the tasks in there. So in that case, a journal entry is normally called a general journal entry. So every software would have some sort of function where you can go in and enter general journal entries. Now, if you're very new to it, only use general journal entries if you're absolutely sure what it is. It's good to talk it through with a more experienced colleague, or even maybe with your auditor or accountant. And once you know your debits and credits are right and they balance, then you can go ahead and make it. So we should only use general journal entries if there is no other choice. Again, if your software such as Sage 50 or QuickBooks has other functionality, other tasks, right? It's always better to use our software functions for revenue and expenses. Why is that? Well, because your software already knows debits and credits. There's no mistakes, it posted correctly, right? And then another reason is your auditors are supposed to review 100% of your general journal entries. Why is that? Because general journal entries are normally used for corrections, they're also viewed as higher risk transactions by the auditors, right? If somebody wanted to manipulate the records, they would likely use general journal entries instead of the rest of the software functionalities. So the more general journal entries we make, the more work the auditors are going to do, and the higher our audit bill would be, and the higher is the hassle for us at the audit time, because of course they're going to come back to us and ask us all the questions about the journal entries. So now, when the auditors complete an audit, they normally make adjustments. They make journal entries, and those journal entries are referred to as adjusting journal entries. Sometimes you see an abbreviation, AJE, adjusting journal entries. So when you receive a list of adjusting journal entries from your auditors, you post them as general journal entries, because this is where they normally go. Some software would actually have a function for adjusting entries, and you can post them as adjusting. And then if some of them need to be reversed in the following year, as long as you mark an entry as adjusting, it's an easier process. You just click a button, reverse, instead of re-entering it in an opposite way when you have to reverse it. Okay, and this is if this sounds complicated, then you don't have to understand or know those adjusting entries at this point. This is just some extra here. Okay, so we went through the chart here. So again, debit for assets and expenses, and credits for liabilities, net worth, and income. So some of people I work with just have a table like this printed out and put it on their desk or beside their desk. So if they make journal entries on a regular basis, instead of guessing, or is it a debit or a credit, they can refer to the chart, right? So increasing an expense or an asset is a debit, increasing a liability or income is a credit. Now, what happens if we want to decrease income? Say something happened and we have to correct income and decrease it. Well, if an increase to income is a credit, a decrease to income would be a debit. And it works for expenses the same way. If a natural position for expenses is a debit, then if we want to increase expenses, we'll debit them. But if we want to decrease them, we're going to go the opposite way from the natural position and credit the expenses. Again, this is all very technical. If you get lost, really don't worry about it. This only is valuable when you go into practice making journal entries. So when you actually making journal entries, you can refer back to this and hopefully it will make sense. Otherwise, it's very technical and probably not easy to get your head around. So now another tool here that's helpful for understanding journal entries is that all accounts work in pairs, because we're affecting both financial statements, right? So on one side, there's always going to be something affecting an income statement, and on the other side, something affecting the balance sheet, right? And so here's just a little chart to assist us with seeing how that works, making it easier. So if we want to record an expense, we have to think it through. Okay, what's affected? What's affected on the other side? So if I paid, say, hydro, right? So then I know hydro expense is affected on one side. I have to increase that. But what's affected on the other side? Well, how did I pay it? Did I pay it through the bank? Did I use a credit card? Or maybe I haven't paid it yet. I just recorded the bill for my hydro, and then the increase in liabilities is accounts payable, right? Because that's an amount that's still payable to hydro and going to be paid in the future, okay? So again, this is the natural position for all these accounts. So the pair for expenses is accounts payable, bank, or credit card, depending how we paid or recorded it. Now, for revenue, on the other hand, we have accounts receivable or bank as a pair. So if funding already came through, then we would increase bank, right? We would think it through and say, okay, bank has increased because government made a deposit for the funding. Now, if funding hasn't, if say it's not funding, it's maybe accounts receivable for a sale. Say our grocery store sold some gas to the school and the school is paying a month from now. So we're still recording the revenue, but then what's affected on the other side? Well, now there is a receivable from the school. So increase in revenue and increase in accounts receivable. Capital assets, so those would be our vehicles, buildings, any sort of long-term investment assets that they use for longer than 1 year. So if we're buying a building, right, again, we need to think through what happened on the other side. How did we pay for it? Did we just pay in cash and then our bank needs to be reduced for the payment? Did we use a credit card, which we probably wouldn't for a building unless it's a tiny one? Or did we buy it on account and we still have a payable that needs to be recorded, that needs to increase? So again, we have accounts payable, bank or credit card as a pair. A depreciation expense. So we talked about it in one of our sessions. This is an allowance for capital assets, for my long-term assets aging, right? So if I bought a building for $100,000, I record it as an asset that's not expense, but every year I have to expense a part of it because the building's getting older, and by the end of its useful life, I want to reflect that it really has no value anymore, right? So if I'm saying that building is going to last for 20 years and I paid $100,000, then every year I will expense 1/20th of the value of the building, or $5,000. That's my depreciation. Okay, so for depreciation expense, there is a liability account or a reduction to your capital assets on the balance sheet. It's called accumulated depreciation. And then for bad debt expense, so if we have to write off some customer accounts, there is a credit account on the balance sheet again, called allowance for doubtful accounts or doubtful accounts receivable. Okay, so when we make a journal entry, again, very important, they're not isolated from what we do in real life, from what we do in operations. We first have to think through what was the flow of the transaction, right? Like what happened? Like if I made a car payment, right? What's increasing or decreasing, right? So clearly making a payment, either my bank account is decreasing or my accounts payable increasing or credit card payable is increasing. Now, what's increasing on the other side for the car payment? If I'm expensing it, then it's a vehicle expense, right? If I have a car loan, then maybe that's reducing the loan amount. So I have to think through what happened here, what's increasing and what's decreasing. And there is at least a pair. There is at least two accounts, two categories, two things that got affected. One of them would be on the income and expense side. The other one them would be on the net worth side, my assets and debt, right? So based on the transaction flow, now say we understand the transaction flow. Let's go back to something simple. Say we bought groceries using our credit card, right? So again, what happened? Well, my grocery expense increased, right? And then my credit card debt increased. On the other side, I owe more to the credit card. So what I would do next is actually go back to my little table here and say, okay, I'd like to increase expenses. So is it a debit or a credit? And here it says expenses, natural position is debit. So debit grocery expense, say $100. And then the other side is clearly credit, because that's another thing, because there's always just debit and credit. If you absolutely sure about one side, the other side is automatic, right? So you only have to know 50% right. So I debit expenses, my grocery expenses $100, and then I credit my credit card, because that's a liability, and I'm increasing the liability, credit card payable, and it's here it says it's in a credit. So, and there's some questions here to hopefully make it easier for us. So what account pairs are affected? What pair is affected? What are the natural positions of these accounts? And are we increasing or decreasing the accounts? Okay. Now for journal entries, there is always a date, like for every transaction in our accounting system. And we normally use the date from the most relevant supporting document, right? So if I'm recording a credit card receipt, I would use the date of the receipt. Now, sometimes we're making those journal entries because it's a year end and we have to correct a bunch of accounts in our system in preparation for the audit. So in that case, we can just use the year end date. Just effectively, we're just fixing the year end, so year end date is relevant. Now, journal entry description, it's very important. Many times we see people making journal entries and, they understand what they want to accomplish, so they kind of omit a good description, put a very short one that doesn't necessarily make a lot of sense, right? Well, it's very important to put a meaningful description for every journal entry that makes sense to you and will make sense to the auditors. So the auditors, that's one thing. When they review your journal entries, if there is no description, then right away raises a flag, right? Or if the description is not very clear. So make sure you describe them very well. Now, the more important thing, even though sometimes we may think auditors are the most important, but really what's most important is for us, when we look back at what we did on a certain account, that we understand it. And sometimes we look back a few months after, or even a year after. Maybe we did in the beginning of the year, and now it's audit prep time, right? And because we have so many things on the go, most of us, it's hard to remember what I was thinking at the time I made the journal entry. So unless I have a really good description in there, I'm going to be staring at the journal entry, it'll be staring back at me, and we won't have mutual understanding, right? I will be spending a lot of time trying to figure out what the heck I was thinking when I was making an entry. So very important to make a good description. If your software has functionality where you can attach a document that supports your journal entry, lots of software have functionality where you can electronically attach a scan or a support document, that's even better, right? So the more clear we make it to whoever looks at it, the better it is for everyone. Okay, so let's go through some journal entry examples. A bit bigger here so you can see well. Okay, so remember, depending on your system, you may be recording some of this as journal entries, or maybe you have a simpler system where you will just be performing a task. But the system is making a journal entry for you in the background. So it's good for us to understand what the system is thinking, how it's working. So we're recording a customer invoice. We want to increase accounts receivable. So it's band office, it's bought fuel from the store. And we want to increase revenue. So this is an invoice for, say, a gas station or a store at the community. The band office bought on account with some fuel. So the store has revenue from selling the fuel and a receivable from the band office. That's what happened, right? So if we go back to our little cheat sheet here, well, that's on the presentation, but hopefully you'll remember that the revenue natural side is a credit, right? Actually, let's look at it. So what's happening here, we're increasing revenue, right? Sales at the gas station and increasing accounts receivable, right? Because the band office owes the gas station now. So now let's go back to our little cheat sheet here. Okay, so increasing revenue or income, well, natural position is credit. Increasing accounts receivable, which is an asset, that's what I own, right? I'm gonna convert it into cash when they pay, that's a debit. So, oh, I guess I have to share to continue. So the entry is then credit revenue to increase it and debit in accounts receivable to increase it. And here you can see there is a description, invoice number 1, Ben office, fuel, okay? So now customer payment, the Ben office is paying the invoice, say a month later. So what's happening here? Well, we have that account receivable sitting from the Ben office, so we have to reduce that. We have to decrease account receivable, and we have to increase our bank, right? Because now they're actually transferring money to the bank or giving us a check that we'll deposit. So again, we have to decrease accounts receivable, which is an asset, and increase a bank, which is an asset. So if you remember from our previous entry, natural position for assets is debit, right? So if I'm increasing a bank by $1,000, I'm debiting bank. But now I'm decreasing accounts receivable, which is another asset to record that payment. Well, to decrease accounts receivable, because it's the opposite of an increase, and increase the debit, the opposite is a credit. And again, in here, I just really need to know one side, because once I know one side, I'll know the other one. The other thing you'll notice about this particular entry, it's really only affecting 2 assets. It's affecting just balance sheet. It's not affecting income statement. And some entries are gonna be like that. They'll just affect one financial statements instead of both of them, just because this is the flow of transactions. But majority of your entries would affect both financial statements, right? And this entry here, it's actually a follow-up to the first entry to recording revenue. The first entry affected both financial statements, and that's just a follow-up to convert the receivable we recorded into cash upon payment. Okay, hopefully it makes sense. Okay, let's look at a vendor bill. So what happened here? We paid chief and counsel's cell phone bill, looks like. And on the bill, there is HST amount, and that HST is recoverable for our organization. And then actually we haven't paid it yet. First, we recorded the bill in our system when we received it. And then later, say a month after that time, upon due date, we made a payment for that bill. So what happened here? We have to increase telephone expenses. We have to increase HST receivable because it's our asset. We will recover it with our next HST return. And we have to increase accounts payable, right? Because we're not paying yet, so we owe that money to Rogers in this case. So again, our expenses natural position, let's go back to our little cheat sheet here. So expenses natural position is debit, right? We're increasing expenses. Accounts payable natural position, which is a liability, accounts payable or liability, is a credit. And then HST receivable is an asset because I will get that money back in the future. So it's a debit again. So going back to my journal entry, increase telephone expenses, debit telephone expenses, increase an asset, HST receivable, debit HST receivable, increase a liability, which is accounts payable, credit accounts payable. You will notice that both sides here, debits and credits, are equal to each other, right? Just like we said. Now, making a bill payment, now we actually paying that cell phone bill. So again, we have to decrease a liability, our accounts payable. Natural position for liability is a credit. So to decrease the liability, we have to debit it. Debit accounts payable. And then we have to decrease bank because now there's less money in the bank, money now in the bank, right? So bank is an asset. Assets are naturally in a debit position. So to decrease an asset, we have to credit the bank. Okay. So debit accounts payable, credit the bank. Recording bank charges. So we're increasing bank charge expenses and decreasing our bank, right? So hopefully we remember by now expenses natural side is debit. So we debit bank charge expenses. And then asset, bank is our asset, natural side is debit, but because we're decreasing it, we have to credit it, right? And again, for as long as we know one side, that's all we need to know. The other side is automatic. And we have a laptop purchase here on a Visa. Okay, so a laptop is an asset. Asset is naturally in a debit position. We're increasing an asset, so we have to debit our equipment account, okay, where we put our laptop. So debit equipment, $1,500. Again, we have HST receivable here of $195. And HST receivable is an asset because it's recoverable. We'll file a return and we'll get it back. And then we have to increase Visa payable, which is a liability, naturally in credit. So credit Visa payable. Okay. Receivables write-off. So say we have to record bad debt expense for uncollectible receivable. So bad debt is an expense. Expenses are naturally in debit, increasing an expense, debit, bad debt. Now there is HST that was a part of it. I remitted that HST to the government before when I recorded the sale. Now I get to claim it back, so it becomes an asset. So debit HST receivable. And in this case, I'm reducing accounts receivable by that bad account that's never going to get paid. Remember, accounts receivable are an asset, naturally in a debit position. So to reduce accounts receivable, because they're an asset, we have to credit them, right? Natural position is debit, so increasing is always with a natural position. Decreasing is the opposite, so credit accounts receivable. And the last, not the last one, a few more. So ISC funding, so what happens here, we have different funding programs. So in this case, we just use a couple of them, or like 4 of them, right? So hopefully we have either different accounts or we have different departments, different programs, right? So revenue coming in, again, income is naturally in credit, income or revenue, right? And then it's coming in directly to our bank account. And bank is naturally an asset, naturally in a debit position, right? So credit all these revenue accounts and debit the bank account. You can see here that there is more than one line on the credit side. Again, this is normal, not an issue at all for as long as my total debits agree my total credits. Okay, and finally, the last one here. This one is more complicated, so that's a payroll journal entry. Okay, so all the wages we pay our employees, they're an expense, right? That's money going out of our business or organization for our operations, right? But now the other side of it is some money is going out of the bank, but some money is put into payroll liabilities. So whatever I deducted from my employees and whatever I have to remit for CPP, for EI, for maybe group insurance and pension, that's going to sit in accounts payable until it's actually paid. So it's going to sit in a liability because normally we make payment once a month, maybe twice a month for some of us, okay, for payroll liabilities. So you'll see here, all wage expenses, we're increasing expenses. Expenses are naturally in debit. So I have all different wage expense accounts in my system. I'm tracking everything separately in this example. So I have wages, I have EI expense, I have pension and group insurance expense, all separate accounts, right? So I'm debiting all these expenses in separate lines because I'm increasing expenses. And now the other side, like because I'm so confident wage expense increases the debit, the other side is automatically a credit. Whether we want to think about it further, the other side are either decreasing a bank account that's an asset and is naturally in debit, so a decrease would be a credit, or increase in a liability, all these payroll payables, right? All these payables related to payroll. A liability is naturally in a credit. So to increase liabilities, we credit liabilities. So again, on the credit side, I have payroll liabilities and a reduction to my bank account, money that was actually taken out of my bank account. Okay, we're at the end of our technical session.